Hi, my name is Jia Liu. I'm an economist at AIER. Today, I'm going to talk about the financial instruments which are available on the financial markets for you to invest. The presentation will be mainly focused on introducing the financial instruments, like what they are and what is the benefit and what are the costs of each of them. But this is going to be on very preliminary level. If you wanted to know more about how do you come up with your own portfolio and how do you evaluate the performance of your portfolio, we have some other sections for you to look at. For today's presentation, I would like to start with giving you a big picture of all these financial instruments I'm going to talk about. I try to put all these financial instruments into 3 characters, but please know that this is not a complete list. There are more, but those are the major products, financial products, when you are facing to make your financial decisions. I'm going to start with the cash instrument. It's called cash instruments because it's cash equivalent. So it's, in other words, it's like cash. They are deposits, they are loans, commercial papers, and treasury bills. Of course, they are like cash, so they are very liquid, so the risk is low, so you will have the lower rate of return. So if you want to get yourself involved in a longer investment, here is the capital market securities, like long-term bonds and stocks. Long-term bonds is still the debt. It's just longer-term debt. And the stocks is the ownership. As we all know, stocks are very risky, but they will give you a higher rate of return. And lastly, there are very interesting financial instruments I would like to briefly mention, which are called derivative instruments. Derivative instruments, they are not debt. They are not ownership. They are not your asset. They are contracts, agreement that you agreed to buy a certain asset from other people at an agreed price in the future. You can use the derivatives to hedge your risk, and you can also use the derivatives to speculate, to make profit. They are extremely risky, but the profit, it could be extremely high. So I will give you more details, but I would like to ask you a question first. What is your risk attitude? Some people could say, I like risk. I'm a skydiver. I go to, skydive, so I'm a risk lover. But in finance, everyone is risk averse. So if I give you a certain return, the lower risk, the better. For example, if I borrow money from you and I tell you I will give it back to you, the same amount of money with interest. For example, I borrow $5,000 from you, and I will give you $500 as interest. So your return is certain. And what if I tell you I will pay you back in 10 days, or I will pay you back in 1 year? Which option would you prefer? Of course, you want your money back earlier. The earlier, the best. Because the earlier means the risk is lower. Because if I have your money for longer term, it's risky for you. Maybe I will just run away. I will never pay you back. So you would like to have your money back as earlier as possible. So with the certain result, you want a lower risk. The lower, the better. So everyone is risk averse. Even though you think you love risk, you go to skydive. But in economics, you do this risk behavior. You are a risk taker because this risky behavior gives you a high utility. In economics, everyone is trying to maximize your utility function. And skydive apparently can give you a great pleasure. So you take the risk for compensation. But in finance, your utility is only measured by money. So people are willing to take risk as long as they can get compensation for taking risk. But someone is more risk averse, someone is less risk averse. So in finance, we have 3 types of risk attitude: risk averse, risk neutral, and risk loving. Understanding how you deal with risk is the first step to managing your financial investment. So let's play a game first. If I flip a coin and I tell you I will give you $100 if it comes up tail, and if it comes up head, you'll get nothing. So you could end up with $100, you could end up with nothing. How much would you be willing to pay to play this game? I give you 1 minute to think about this question. I have 5 answers. A, you would pay nothing, which means you don't want to play at all. B, you would like to pay less than $50. C, you would like to pay exactly $50. No more, no less. D, you would like to pay more than $50, but less than $100. D, you would like to pay more than $100 to play this game. Okay, here's a little heads up for you. As we all know, if I flip the coin, it's random, right? So there is 50% chance you will come up tail. And also there is 50% chance you will get the head. So 50% chance you will get $100, and 50% you will end up with nothing. So the expected payoff is $50. 50% times $100 plus 50% times 0. So the expected payoff of this game is $50. Okay, here, check your answer. If you choose A, even though you could have $1,000 at the end, you still don't want to play this game. You do not want to take any risk. You are absolutely risk averse. So you have cash. You are happy with it because you don't like risk. So you could either keep your cash at home or deposit in a checking account, and you are happy with it. Then that's fine. And congratulations, you are done today. You don't need to hear more about my presentation. Just be happy with your money at home or in your checking account. But if you choose B, you are waiting to pay something, but not as much as $50. You are relatively risk averse, even though the value of the game is $50, but you only are willing to pay less than that. So you are relatively risk averse. If you pay $50, you are rational, you are smart, because the game is only worth $50. We call you risk neutral. If you are willing to pay more than $50, well, you hope for the best. You like risk. You think it's likely for you to have $100. So you would like to pay more than the value of the game. You are risk loving. If you would like to pay more than $100, well, I really hope you just did the math wrong. Because the best you can do is to get $100. How come you want to pay more than $100? It is irrational decision. So I sure hope you just did the math wrong. So if your answer is B or C or D, this presentation will provide some valuable information for you. I will start with the cash instruments. This is the least are the least risky instruments you can invest. But of course, like we said, lower risk, lower return. First of all, you can buy the certificate of deposit. We call it CD. It's just like money in the bank, but it's better than your checking account because it has the fixed interest rate, which is higher than the interest you get from your checking account. And it has the fixed term, like monthly, 3 months, 6 months, and 1 to 5 years. So it's relatively short-term debt. There's one major disadvantage to this instrument, which is you are supposed to hold CD until it matures. So if you want to withdraw your cash before maturity, you will have to pay for the penalty. And for 5-year jumbo CD means you have to deposit with a minimum of $100,000 in the bank. So it is jumbo CD. And the rate for 5-year jumbo CD is around 1.9% currently. And for 1-year regular CD, you don't have as much as $100,000. You have less than that. And you only deposit it in the bank for a year. The rate is around 1%. Okay? But please keep in mind that CD, you are not supposed to withdraw the cash before maturity. You can, but you will have to pay the penalty. The second cash instrument is commercial paper. Commercial paper is the short-term debt from the companies. So you can also call it short-term bonds. And the benefit, one of the benefits are because it's from the companies. It is basically companies are trying to borrow money from the public for the short-term debt. So they have a wide range of maturities. So you can choose like 3 months, 6 months, even 30 days, 90 days, a lot of maturities you can choose. And usually, commercial paper is sold at a discount from the par value. Think about it. This is a short-term debt from companies. And companies, it's possible, or even for some companies, it's likely to go bankruptcy. So it's risky. So the people will only pay less than the par value to buy this commercial paper from companies. So they kind of have to sell it at a discount. And one of the benefits for commercial paper is they provide exit options. So you do not have to hold your commercial papers until the maturities. So it's a big benefit. I have an example here. Speaking of the rates fluctuate with the market conditions. So it's really hard to tell you what is the rate of return look like. But currently, for 90 days commercial paper rate from AA non-financial companies, 90 days commercial paper rate is around 0.11%. Okay. It's only for 90 days, so the rate is kind of low. And it's from AA non-financial companies, the ranking of the credits for those companies is pretty high, so the rate is relatively low. But good news is you can exit before maturities. And the next one is Treasury Bill. Treasury Bill is the short-term government bond. Commercial paper is the short-term debt from the companies, but Treasury Bill is the short-term government debt. So this is the way the US government is financing itself for short-term debt. And usually the maturities is less than 1 year because it's short-term. And usually they are zero coupon. Zero coupon means no interest. No interest while people still want to buy it because they are usually sold at a discount. So for example, it's worth, the par value is $100. So at maturity, you will get $100 back, but you can buy it now for $50, for example. I just make up the numbers. So you still have kind of return. Even though there's no coupon payment, but you still can have return because they are sold at a discount. But those are just the short-term, like cash equivalent instruments. But if you are waiting to invest for longer term, because we all know if we invest for longer, you will get more, you will get higher return. So here's the options. First of all, you can get into the capital market securities. First of all, long-term bonds. Long-term bonds, we are going to talk about two kinds of long-term bonds. One is government bonds. Government bonds, the only difference between the government bonds and Treasury Bill is this is also government debt, but this is for longer term. The maturities usually for Treasury bonds is 20 years, 30 years. But they have credit risk, they have currency risk, they have inflation risk. Credit risk is, this is the debt from the government. It is very unlikely for a government to default, but it happened before. In 1998, in Russia, Russian government defaulted on its currency debt. But let's hope it won't happen in the US, but it's possible. And it's currency risk. Currency risk, for example, the Chinese government purchased a huge amount of the US Treasury bonds. So now the US dollar has been depreciating a lot. So when they mature, China can only get US dollar. But since US dollar has been depreciating, so when they convert US dollar to Chinese yuan, they get much less. This is your currency risk. Inflation risk is for any kind of investment, you will have inflation risk. Even you don't invest, you will still have inflation risk because the things are getting more and more expensive. So if your rate of return is lower than inflation rate, basically your real return is negative. You are losing money. And corporate bond, because this is the debt from companies, of course they are riskier than the government bond, but they will have a higher rate of return. And they also have interest rate risk, they also have coal risk and inflation risk. I will talk about this more later. You don't want to expose yourself to currency risk. So let's see, if you want to invest in the US, you don't want to get yourself into this exchange risk. You can just buy the US government treasury securities. So you don't need to get involved in another country's currency. So I want to talk about two kinds of US treasury securities. One is treasury bonds. Usually it has maturities for 20 or 30 years, long-term investment. But the good news is you get coupon payment every 6 months. So you will have stable cash flow every 6 months. And currently, 20-year treasury bond rate of return is around 3.33%, and 30-year is 3.63%. Okay. It is much higher than the short-term bond, of course. You put your money, you lend your money to the government for 20 years. This is what you get, around 3.3%. And if we are worried about inflation risk, like we just discussed earlier, here is the one security you can buy, which is called Treasury Inflation Protected Security, or TIPS. This is a principle, okay? For any kind of bond, you have principal, you have coupon payment. So for principal, the principal of the bond is adjusted to the inflation rate. Inflation rate is measured by CPI in here, in this case. So you have constant coupon rate, but if inflation goes up, your par value or principal will go up accordingly. So even with the constant interest rate, coupon rate, your coupon payment still will go up because principal times interest rate is your coupon payment. And at maturity, you will get the principal back. So you will get more money back at maturity, and for every 6 months, you will get more coupon payment back due to the increase in the principal. Usually, this TIPS has 3 maturities. You can choose 5 years, 10 years, and 30 years. Okay. But corporate bonds have been very popular, even though they are riskier than the government bonds, because people still buy them because they pay better. Okay. So I list all the benefits and the costs you can consider. First of all, like we said, higher yields than the government bonds. And secondly, because they are from different sectors, from different companies, so you have a lot of choice. You can choose different bonds from different companies, so you can diversify your investment. So you like this company, you like that company, you can make your own choice. But government bonds, we only have one government. And there's one major benefit. Because of the size and the liquidity of the bond market, it will be very easy for you to sell your bonds before maturity. So you have flexibility. You do not have to hold your corporate bonds until maturity. And this corporate bonds market has the huge liquidity, and the size is huge. So it's easy. No problem, you can sell it. But everything comes with cost. Default risk. Companies are likely to go bankruptcy. And corporate bond is the money you lend to the company. But what if they go bankruptcy? It's likely you won't have your money back. And interest risk. Okay. This is a little bit complicated, but interest risk is referred to as when the market interest rate increase. And the new issuers, if the company is trying to issue new bonds because of the market interest rates are higher than before, they have to offer higher rate of return now. So the same company has the same bond, but the new issues have a higher rate of return. So what is the result? Your old bonds will be worth less, right? Higher yield means lower price. So you can only sell your bonds at a lower price even though you are not doing anything, just because the market interest rate goes up. So it's called interest risk. Another risk is a call risk. Call risk means some callable bonds allow the issuer to retire the old bonds and replace these old bonds with a lower yield new issues. So all of a sudden, okay, I have the debt from your company, and then you told me you have to retire the bond, and you will have a new issues I can buy. You will have a new bonds I can buy, but I can only offer you lower yields. This is bad news for me, right? I didn't do anything, but you tell me that you will replace my old bonds with a lower yield new issues. This is callable bonds. Of course, due to this call risk, usually the rate of return or interest rate for callable bonds are higher than uncallable bonds. There's another type of bonds called uncallable bonds. So the issuers cannot do it. They cannot retire the bonds before maturity. Okay. Also, the interest income, coupon income, and capital gain, if you sell your bonds in your market at the higher price than you paid to buy the bonds, you will have capital gain. And capital gain and interest payment income are taxable. Not like stock, they are taxable, like your ordinary income. Inflation risk. Every investment has inflation risk. Even you don't invest, you just sit at home with your cash. If the inflation goes up, everything becomes more expensive, your purchasing power will be lower. So this is inflation risk. Only tips, the inflation protected Treasury bonds is inflation protected. But corporate bonds, there's no inflation protected corporate bonds. They have inflation risk. Okay, maybe it doesn't sound good enough for you yet because they are not risk-free, they are risky, but the rate of return is not very high. And if you think you are risk lover, you are risk loving, probably you want to take more risk. But as long as you can get a higher rate of return, here is the stock market you can get yourself into. Stock market, it's very different from bonds. Bonds is debt. Stocks are ownership. You buy a share of stocks from the company, you become owner. And you share the profit or revenue the company will get in the future. If the company is improving, is getting high profit, high revenue in the future, their stocks will be worth more. And it will push the price of stocks up. So you can share the benefit of the improvement or development of the company. But as a debt owner, if you buy the corporate bonds from the companies, no matter my company is doing much better or doing worse, you only get the par value back, right? I owe you $10, you only get $10 back plus coupon payment. But if you are a shareholder, if you have my stock, my company is doing better, you're going to be benefit from that. And stocks also represent a claim to a stream of payments because you will get a coupon. You will get dividends, and you will get the sale price if you sell your stocks on the secondary market. You will get the money back. So this is the price of the stocks. You get dividends, you get the sale price. But mostly, if you want to trade stocks, you will have to work with a broker. But how would you invest on stocks, and what is the regulations, and what is the financial institutions you can work with? This is going to be the next seminar we are going to provide. Here's a graph that can clearly tell you why you want to do bond, why you want to do stocks. Okay. The red line denotes stock returns. As we can see, it's very volatile. The blue line is the bond return. The green line is inflation. So for 1 year bond from 1950 to 2011, it's almost 6 decades. The average return for 1 year bond is around 5.57%. And the average return for stocks in the past 6 decades is around 12.49%. Much higher rate of return. But don't be too happy too early. The standard deviation of the bond return is 3.76%. What is the standard deviation? Standard deviation measures fluctuation, deviation from the mean value, which means the risk. Standard deviation measures risk. So the risk of bond is about 3.76%. Let's look at the stock. Standard deviation of stocks is around 16.36%. Much riskier, but rate of return is also much higher. Okay? The inflation in the past 6 decades is around 3.67%. So if you invest, it's worth it because the rate of return, both the bond and the stocks, are higher than inflation rate. But the bond is less risky and the stock is much riskier than the bond. But for example, I just made a decision for my 401k earlier this year. I'm young, I'm far away from my retirement, so I invest all my 401k on the most risky stocks because the average rate of return is much higher. But as we said, it's risky. Maybe today, the rate of return is like 20%. Tomorrow, it could be negative. But if you are waiting to keep your investment for longer term, like for 30 years, 20 years, 10 years, I really don't care about tomorrow's behavior of the stocks, right? We only focus on the longer term rate of return. So if I only buy bonds for my 401k, for 30 years, for 20 years, the average rate of return is only below 6%. But if I buy stocks, it could be more than 12%. So it's all, whether stocks or bonds, it depends how long you are waiting to hold your investment and how much risk you are willing to take. Lastly, I like derivative instruments, so I have to say something about it. But even for normal people, maybe it's less likely for us to get involved in the derivatives. But derivatives can give you some extremely high return. But of course, it's extremely risky. There are 4 derivatives on the market now: forward, options, futures, and swaps. Today, I will only cover futures and options. Forward is similar to futures, and swaps is about interest rate. But today, we are only going to talk about futures and options. Again, futures and options, derivatives, they are not asset, okay? They are not debt. They are contracts. You agree between 2 parties. You agree with other person or group to exchange an asset in the future, in the future, at a certain price. And for example, I agreed to buy gold from you in next February at $1,500 an ounce. So I'm the buyer of the contract. So we'll see, I long the contract and you short the contract. I long the future and you short the future. And the underlying asset on the contract is the gold. And the price is $1,500 an ounce. And what we can use these derivatives for? There are 2 major reasons why people do derivatives. One is you can use it to hedge your risk, or you can do it to speculate. For example, hedge risk. If you are producing something, you are trying to sell your product, but you do not want to take the risk because the price probably will go down or go up in the future. For example, you are a wheat farmer in Kansas. Now you don't have your product, your wheat, available now, but the harvest will be in 3 months. But if there is a surplus in 3 months, the price will go down. But if there is a shortage, the price will go up. But you do not want to take the uncertain, you do not want to take the risk. You don't care. You don't want to gamble. You just want to lock in a certain price now. So you can enter into a future contract. For example, you agree to sell your wheat to me in 3 months for a certain price. No matter what happens in 3 months, maybe the price goes up, maybe the price goes down. For you, you buy a future contract with me. There's no surprise for you. You can always sell your product at the price you agreed. So there's no risk. So this is, we said, hedging risk. And also, if you have nothing to sell and you don't want to buy, you don't have product to sell, you can also use the future or option to speculate. You want to make profit. You want to bet on the price, the future price. Here's what you can do. For example, you agree. You enter a long position on a gold contract, future contract. You agree to buy gold from me. So I'm the seller. I entered a short position. You have the long position. You agreed to buy the gold at 1,300,000 per ounce. You agreed to buy 3 ounces of gold with me in 2 months for $1,300 an ounce. So what happened? In 2 months, the actual, or we call it strike price, the actual price of the gold in 2 months is $1,400 per ounce. So you agree to buy it, I agree to sell. I have no gold to sell. I have no gold in my hand to sell. So what do I do? But the future is obligations. I have to sell the gold at the price we agreed. So we agreed, you buy and I sell the 2 ounces of gold at $1,300, even though the actual price is $14 now. So what do we do? I buy the gold from the market at $1,400 and sell it to you. And you buy it at a lower price than the market price. So your gain is because you get to buy the gold at a lower price, right? So you buy it and you can sell it later at a higher price. So you gain $1,300 and you can sell it for $1,400. And we agree to buy 2 ounces of gold. So your gain is going to be $200. Even though I have nothing to sell, you don't actually want to buy this product, you can still use these derivatives to speculate. Okay. And futures and options, they are extremely risky. The reason is as follows. Futures, like we already talked about, it's an obligation to buy or sell. So, the future price, we just bet on the future price. Nobody knows for sure now what is the future price going to be, right? So, for futures contracts, you will have to have a margin account, okay? The margin account is usually about 70% of your contract value. You have to put down your money in the account. And the tricky thing is here, your margin account is adjusted market to market to reflect the daily settlement. So you agree to buy the gold at $13,000 next year in February, for example. But tomorrow, the price goes down. Tomorrow's price is $1,200. So you agree to buy the gold at a higher price, so you have loss. But wait a minute, we agreed to buy the gold next year, February, right? Why would you care? But they do care. So even though your maturity is next year, but your margin account is adjusted daily, market to market. So if you have loss tomorrow, and if the value of your contract goes down to the maintenance margin, you will get margin call from your dealer, from your broker. And they call you. You either put more money or we have to close out your contract. So this is extremely risky because you bet on the price in the future, see, next year's February. But if the price goes down tomorrow, maybe the price will go up later, but it doesn't matter. If it goes down tomorrow, you have to put more money to compensate the loss. If you refuse to do so, we will have to close out your account. So if you get into the future, probably you will have to call your broker every day, all the time. It is very risky. And for options is the biggest difference between options and futures is futures, like we said, it's your obligation. You have to buy or you have to sell, right? But for options, this is your right, okay? You agree to buy or sell at a certain price in the future, and when the time comes, when the day comes, and you realize if you agree to buy a product at a lower price and the actual price is higher, you'll be happy. So you can exercise the option contract. But what if the price goes to the direction that you would not prefer, which means you will have a loss? For example, you agree to buy something at $10, but the actual price is $8. Of course, you do not want to buy it at $10, right? Because you can buy it at $8. So for options, this is your right. Keep that in mind. So you can say, no, I am not going to exercise the contract. Forget about it. You can do it. But this gives you privilege, right? Because the futures, you cannot do it. So of course, you will have to pay the premium for getting into the future because you got the right. You choose you want to do it or you choose you don't want to do it, okay? So for example, you have $10,000 you want to invest. If you pay $10,000 for bond or for stock, it is almost impossible. You will lose this $10,000. For bond, you will get the money back as long as the government, doesn't default or the company doesn't go bankruptcy. Even the company goes bankruptcy, you will get your debt back before the shareholders. So it's almost impossible for you to lose this $10,000. But if you pay $10,000 to get into the option, this $10,000 is a premium. It's like the ticket you pay for playing this game. So if the price goes to the opposite direction you would hope for, which means you will lose. So you say, forget about the contract. I'm not going to do it. Fine. You will lose the premium. People say, if I get into options, the worst I can do is I lost the premium I paid. Yes, but you lost all of them. If you use the money to invest on stocks or bonds, you will get the money back. For stocks, you will hope you'll get more money back, right? For bonds, you will get the principal back plus the coupon payment. But if you enter to option contracts, you would end up with nothing quickly, because it is the bet, it's a gamble. You bet on the price. If you buy the contract, you bet the price will go up, so you get to buy it at the lower price, right? But if the price goes down, you do not want to exercise the contract. So you don't want this contract anymore, but you will lose your premium. All the money you pay to get into the game, okay? So the options and futures are extremely risky. But the rate of return for options, for futures, could be unlimited. If you buy a lot unlimited contracts, you buy a lot of contracts, the price even just go up by $1. Since the size of the contracts you get into is huge, you could gain a lot. So it's extremely risky, but it's still, again, the rate of return is also extremely high. You would ask, how do we get into this financial market to buy all these financial instruments? But this topic, today's presentation is not going to cover that. And we have a different seminars coming up for institutions and institution regulations for the financial market. And we also have a seminar in 2 months about how do you form your own portfolio and how do you evaluate your investment. But today, this is all we are talking about. Thank you.